tightening is over, QE is resuming, rate cuts are coming, and there's all sorts of stimulus that is coming from the Treasury Department, whether it's Fannie and Freddie Mae, deregulation, stimulus checks before midterms. And so I think we're bottoming out in the liquidity cycle. So Bitcoin is really figuring out its identity, understanding that these Treasury MNAVs might not have been the right narrative, that understanding the ETF participants. And I think liquidity will resume, will turn up, and Bitcoin will be the best expression of that. So it's all good. It's just the market needs to digest kind of what's been liquidity dislocation. There's been a lot of campaigning and future promises on printing money, reindustrializing, ending QT, starting QE, go, 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 go. And then we ran a surplus, and then the government shut down. And then, well, who's actually net long these ETFs? How important is the basis trade? Well, what are these treasury companies? I see the market just gathering itself a little bit, which is obviously, if you believe in the thesis that currencies have to continue to be debased and the sponge of sorts to absorb the excess liquidity that sovereigns have to print is going to be gold and Bitcoin. This is a great opportunity to add to those positions. I think it's really that simple.
In a financial world where central banks keep pumping money while governments juggle record high debt and persistent inflation, one asset is refusing to stay on the fringes. Today, Bitcoin is not just a speculative play. It's increasingly a structural bet. With the price having fallen below $90,000 as institutions pause and retail waits for direction, the real story lies not in short-term swings, but in how public companies, sovereign states, and asset managers are quietly building frameworks around it. Corporate behavior tells the story. MicroStrategy continues adding to its position, while Tesla, Block, and Marathon have held through volatility. Not exciting, but consolidating. Asset management giants such as BlackRock, Fidelity, and Franklin Templeton are legitimizing Bitcoin as a treasury asset through record ETF participation. Mallers notes that this institutional foundation, not short-term price action, is the real signal. Infrastructure being built now for corporations, and sovereigns preparing for a world where money can't be printed. At the sovereign level, the conversation is evolving too. El Salvador continues to build state-level Bitcoin infrastructure. Argentina's new administration has openly discussed integrating Bitcoin into economic policy, and regions across the Middle East and Africa are exploring Bitcoin as a tool for energy monetization and financial independence. Mallers argues that Bitcoin now acts as a real-time indicator of global liquidity. Tightening drives weakness, stimulus drives expansion, because unlike fiat currency, Bitcoin cannot be printed to solve political problems. So what looks like surface-level weakness, sideways price action, nervous sentiment, unwinding leverage, may instead be a structural reset, a cleansing of exaggerated ETF narratives, long-term holders realizing profit, and institutional buyers quietly accumulating without moving the market. And if this is the end of the tightening cycle, as Mallers suggests, then the return of liquidity, rate cuts, and balance sheet expansion could collide with an asset whose supply cannot increase. Stick around until the end, because we're breaking down the real forces shaping Bitcoin's next chapter, liquidity turning points, institutional positioning, and why the unwind of ETF basis trades is revealing genuine demand under the surface. Also guys, if you like our cryptocurrency content, please remember to like and subscribe to stay up to date. Now, let's hear Jack's thoughts.
I think broader markets in risk are selling off, just generally speaking. Bitcoin tends to lead that because Bitcoin tends to be one of the only accurate smoke alarms for fiat liquidity we have left in the world. And I hold the thesis that that's because Bitcoin's the only truly free market that we have left in the world. But what I think markets are going through right now is really trying to digest what has become a complicated liquidity situation. So, I actually, as preparing for this show, I pulled up my US liquidity index. The US liquidity index that I look at is down 10%, a little over now, over the last 6 months. So I think the story is this Trump administration came in, they campaigned on lots of liquidity, reindustrialization, lots of GDP growth. And that narrative was a little confusing with Elon Musk and Doge, and that Elon Musk was going to send us into austerity by running the US government like a lean startup. And then that didn't work. And then we had the trade wars and we had Liberation Day. And after Liberation Day, there was taco, Trump always chickens out, and the markets then front ran liquidity. You saw Bitcoin separate and front run what the markets assumed to be more liquidity coming, that there was going to be a truce with China, tariffs were going to be a little bit more mild than they were advertised to be, and that the US would find a way to work with the Federal Reserve and reindustrialize this country and print lots of money to make whole on the promises of the campaign. And I think that hasn't happened. Most specifically that I want to highlight is in September, the US government ran a $200 billion surplus. So that is an annualized surplus of over $2 trillion. And then in October, the government shut down. And so this has been one of the tighter liquidity periods for markets generally. I think the combination of AI, this administration, and the lack of liquidity follow through markets are just trying to wrestle with. And so Bitcoin is correcting back towards where it was before this administration got going, because it's unclear where the liquidity is going to come from and when it's going to come. To me, Bitcoin is priced on future expectations of fiat liquidity, period. Bitcoin is the antithesis of fiat. Fiat has no supply cap. Bitcoin is finite. Fiat can be censored. Bitcoin can't. Fiat cannot be audited. Bitcoin can be audited by anybody. And so Bitcoin is the best expression of fiat. And so if there's tightening of fiat liquidity, then Bitcoin is going to be the smoke alarm that shows us that. And so I actually put out a post on X over the weekend where I said, gold making new highs this year shows us that governments and central banks have to print, but Bitcoin falling from highs right now shows us that they might have a liquidity crisis before they're forced to. And so I think the two assets play different roles, and that Bitcoin is a very accurate smoke alarm of where liquidity is today, rather than the gold market is sniffing out where this is inevitably going, right? We know QT is ending, QE is going to have to restart, rate cuts are coming, and there's all sorts of stimulus, whether it's Fannie Mae, Freddie Mac, a housing crisis to be declared in 2026. So I see this as a buy the dip opportunity. The way to monetize a currency failure is to not bet that the stock market's going to go down 50% like Michael Burry and have your fund shut down. The way you do it is by owning a better currency than the dollar, which would be something like gold and Bitcoin. So this is a buy the dip opportunity for me. I think liquidity has to come physically. There's no other option. And this is just a mere reaction to the lack of follow through from the administration. You know, Bitcoin has been, and I'm not saying that this is how I value and view Bitcoin, but historically Bitcoin has been some combination of a hard money alternative, a neutral reserve asset like gold, and technology. You know, you can make the argument that Bitcoin's macro thesis or macro value is that it is technology plus fiat liquidity. And so it's been relatively correlated to the NASDAQ with the properties of gold. And so the market is still trying to figure it out. But the way, again, I would encourage everyone to pull up a US liquidity index chart and a Bitcoin chart, and they're relatively correlated, which is, I think, what we all want. We all want the best expression of fiat debasement, that we all want to own something that is the opposite of someone being able to print time and energy out of a central bank while I have to get up out of bed and work for the currency. And so I think the market is still maturing in its ability to price Bitcoin. Gold is definitely leading in where the world is going. And Bitcoin is acting more as a real-time index in how that progress is working towards the inevitable future, which is we're living through a sovereign debt crisis. I mean, at the end of the day, that's the problem, is that these sovereign nations are in way over their head. And gold is sniffing that out. We're going to have to reprice the world around us in a significantly weaker dollar. And Bitcoin is taking us along that journey. But in part of you're exposed to more volatility with Bitcoin. You're exposed to more of the extremes, but that's to both the downside and the upside. And so, you know, to each their own. I prefer owning the best performer. And so these are buy the dip opportunities for me, and 25% off highs during a liquidity crunch where the government shut down and is reporting surpluses and $200 billion. It's no problem for me.
Yeah. As markets digest one of the sharpest liquidity squeezes in over a decade, Bitcoin is behaving exactly how Mallers says it should, as a real-time gauge of global liquidity, not a 4-year horoscope cycle. With the Fed's balance sheet now nearly $3 trillion smaller than its peak, and tightening policies pushing risk assets into retreat, the ETF narrative that dominated headlines earlier this year is finally being stress-tested. What's emerging beneath that stress is a reset. The supposed institutional demand many expected from ETFs has revealed a different truth. Much of the early activity wasn't directional conviction, but basis trade arbitrage. Hedge funds and banks like Goldman Sachs exploiting spreads between CME futures and spot ETFs. When those spreads disappear, so do the inflows, and what looks like capitulation is often just unwinding leverage rather than abandoning Bitcoin. But Malice points to something far more important happening beneath that noise: long-term capital stepping in. University endowments like Harvard, firefighter pension funds, and conservative institutional allocators are using ETF liquidity to accumulate, quietly absorbing supply, even as legacy whales take profit after more than a decade of holding. It's an almost IPO-like rotation: early believers cashing out, long-duration capital replacing them, and markets repricing in real time. And this all unfolds as the macro backdrop prepares for a turn. The Fed is signaling that QT may end, rate cuts are being telegraphed, and Washington is floating new stimulus measures heading into election season. Mallers argues that once liquidity returns, whether through balance sheet expansion, regulatory adjustments, or fresh fiscal intervention, Bitcoin is positioned to be the cleanest expression of that shift, precisely because its supply cannot react. In his view, this period isn't a collapse of narrative, it's a cleansing of the wrong ones. Not the death of institutional adoption, but the clearing of misconceptions around ETFs, treasury companies, and Fourier cycle mythology. What remains as the dust settles is Bitcoin finding its footing as the asset most directly tied to liquidity, sovereign debt risk, and the next phase of monetary expansion.
Listen, could Bitcoin go to 85, 80? Probably. But, I think there's two things. There's a really healthy cleanse of narratives within Bitcoin. I think that there was the narrative was ETF institutional demand. Well, a lot of the ETF flows are the basis trade, is, arbitraging futures with the ETF. And then there was the Bitcoin treasury narrative, which we can talk about as I'm the CEO of 21. We're not a treasury company. We think we're substantially different than that. But there was this idea that institutions were gaining exposure to Bitcoin through these Bitcoin securities, and that there was an MNAV premium to that. And a lot of that's unwinding, which I think is very healthy. And so I think we'll find a bottom when the market realizes that Bitcoin doesn't trade in 4-year cycles, and that a lot of the institutional narrative was a little bit overblown. But right now people are freaking out. Like, oh my gosh, these institutions, they're unwinding from their ETF positions and they're unwinding from Strategy's MNAV trade, when in reality, I don't think it was ever really there at the size and scale that it was purported to be and that the narrative conveyed. And that Bitcoin doesn't operate on 4-year cycles like horoscopes, like it doesn't align with the stars. It operates on expectations of fiat liquidity, which is what it was designed to do. And so I think once the market relaxes, calms down, then we move on to this next chapter of liquidity. I mean, we're hitting the bottom of the liquidity cycle. That's what I would say here on Kitco. I'm not going to call any Bitcoin bottoms, but QT ends, it's November 18th. QT ends December 1st. The Fed has said they're going to have to start expanding the balance sheet. Just for context, peak Fed balance sheet, we're at $9 trillion. Now we're close to 6 trillion. That is an insane amount of tightening. Never have we tightened more. People often say, well, if China and Japan sold all their US treasuries, then we'd really be in trouble. China and Japan can both sell all of their treasuries at the same time, and they wouldn't have that much impact that the Fed has had over the course of this tightening cycle. And that ends in less than 2 weeks. And so tightening is over, QE is resuming, rate cuts are coming, and there's all sorts of stimulus that is coming from the Treasury Department, whether it's Fannie and Freddie Mae, deregulation, stimulus checks before midterms. And so I think we're bottoming out in the liquidity cycle. So Bitcoin is really figuring out its identity, understanding that these Treasury MNAVs might not have been the right narrative, that understanding the ETF participants, and I think liquidity will resume, will turn up, and Bitcoin will be the best expression of that. There's two real core narratives that the market needs to digest in regards to the Bitcoin ETFs. One is this basis trade. So you're seeing large banks like Goldman Sachs or trading firms like Susquehanna, what is reported as massive Bitcoin positions. And maybe they are taking a directional position on Bitcoin, but the reality is they're running this basis trade where they're able to buy the Bitcoin spot ETF and sell the futures on the CME and capture a spread. And if that spread is returning them more than Fed funds, then that is the equivalent of better risk-free returns for these capital allocators. And so what looks like massive ETF inflows is actually also realized as sell pressure on the futures. And so there's been a misguided narrative that Goldman Sachs cares about Bitcoin just as much as I do. I don't think that's true. I think that they're trading a spread and they're making these markets more efficient. However, it is true in other circumstances, like we've seen Harvard. Harvard has one of the largest Bitcoin positions of any endowment in the world. I think it's one of their largest ETF positions within the endowment, period. Now, those positions are real. And the really important part, Jeremy, is there's been more Bitcoin OGs of folks that have been sitting on thousands of coins for over a decade that have been realizing profit. And so actually more than 50% of Bitcoin that has been acquired is underwater right now because there's been a massive rotation of a lot of folks. Almost think of it as an IPO moment where lots of early investors are realizing some liquidity and some gains. And a lot of the folks like Harvard, like firefighter pensions, they are actually using the ETF to soak up a lot of the liquidity. So I would say it's both. Part of the outflows that you're seeing is because the basis trade is no longer returning more than Fed funds. And you see this kind of cyclical wind and unwind, wind and unwind. And you can track that just by how profitable the basis trade is. But what's encouraging is all the endowments and the pensions that are buying for the long term and treating Bitcoin like a hedge against future fiat debasement. So it's all good. It's just the market needs to digest kind of what's been liquidity dislocation. There's been a lot of campaigning and future promises on printing money, reindustrializing, ending QT, starting QE, go, 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 go. And then we ran a surplus and then the government shut down. And then, well, who's actually net long these ETFs? How important is the basis trade? Well, what are these treasury companies? I see the market just gathering itself a little bit, which is obviously, if you believe in the thesis that currencies have to continue to be debased and the sponge of sorts to absorb the excess liquidity that sovereigns have to print is going to be gold and Bitcoin. This is a great opportunity to add to those positions. I think it's really that simple.
As this discussion settles, the picture that emerges is of a market stripping away illusions and revealing its core drivers. Bitcoin isn't stumbling. It's recalibrating under the weight of one of the most aggressive tightening cycles in modern US history. Trillions pulled from the Federal Reserve's balance sheet, budget whiplash in Washington, liquidity stress across China and Japan, and a global shift toward austerity all pressed directly onto Bitcoin's price and sentiment. And in real time, Bitcoin reflects every tightening turn, exactly as Mallers describes. What looks like panic inside ETFs, outflows, red candles, unwinding exposure, becomes far more nuanced through his lens. Banks like Goldman Sachs aren't abandoning Bitcoin. They're stepping out of basis trades that no longer pay. Meanwhile, long-term holders, who spent a decade sitting on enormous positions, are finally taking profit, creating an IPO-like rotation as institutional buyers step in. Harvard's endowment, firefighter pension funds, and slow-moving allocators use this volatility to absorb supply, silently strengthening the floor beneath the market. At the same time, the macro environment is shifting. QT is scheduled to end. Rate cuts are openly telegraphed. And US agencies are preparing new rounds of fiscal support, from housing initiatives to pre-election stimulus measures. Mallers frames this moment as the bottom of the liquidity cycle, the point where tightening exhausts itself, and the next wave of expansion waits just ahead. And in a world of rising sovereign debt, shaky currencies, and governments searching for ways to reindustrialize and stabilize growth, Bitcoin becomes the clearest expression of what happens when liquidity returns to an asset with a fixed supply. This isn't the collapse of a narrative, it's the clearing of the wrong ones, and what remains is a market preparing for its next identity shift. Thanks for watching, and if you enjoyed this video, please remember to like, subscribe, and share your thoughts in the comments section below.